Hello everyone, today's video is all about IHT planning, particularly around lifetime gifts, just some of the things you need to watch out for. So the first one is the annual exemption. Now this is where anyone can give away assets to the tune of a certain amount per year. That amount is £3,000 and it's per donor, not per donee. I think a lot of people get this wrong. They think they can give £3,000 to, as long as it's per person that they're giving it to. Well, that's not right. It's £3,000 for them, the person that's giving it away. If they haven't used the previous year's allowance, they can carry it forward to next year. So a husband and wife could, in effect, give £12,000 away this year, and that will form part of their annual exemption. They don't have to wait 7 years or anything like that. We'll come on to the relevance of the 7 years. But the annual exemption, £3,000 a year, you can carry forward the previous years only. So that's annual exemption. It's been £3,000 for 40 years, since 1981, and it hasn't gone up since. Now the average salary in the UK 40 years ago was £6,000 a year, so it was equivalent to about half of a year's salary, the annual exemption. So now, unfortunately, it's not going to make much of a dent in IHT bills, but it's still something that you should think about, as part of the lifetime gifts, annual exemption. Right, next one is gifting from income. So the rules say that gifts out of income will escape the IHT net. However, there are certain things you need to look out for. So we're talking about surplus income. So whether it be earnings or pension income, and you can give away the surplus income, and that is free from IHT. Now, the two things specifically, firstly, maintaining records and the regularity of the payments. So on the first one, maintaining records, ideally you should keep a form, and there is an inheritance tax form. It's called an IHT 403, and you just get into the habit of listing your income and your expenditure to prove that it's surplus in the event of when you pass on. HMRC will look at that and say, well, was it really surplus? And you can have all the records to show for it. Now, what tends to happen for people who are not as organised as that, it's after they've passed away and the executors of their estate try and work backwards and retrospectively prove that some of the assets, the gifts out of income, let's get it right, not assets, the gifts out of income that they were giving away before they died, qualify for the exemption. Now, trying to recreate income and expense accounts retrospectively going back 6-7 years is pretty difficult. So that's why I'd encourage people to start keeping records of their income and expenditure, particularly for those who are taking advantage of this gifts out of income exemption for IHT. The second strand of that condition for the gifts out of income is the regularity. So it can't just be a one-off. It has to be a commitment, an intention to continuously pay out of the surplus income. Now, it doesn't have to be a set amount every time, a fixed amount like £5,000 a year or whatever, but it has to have some degree of regularity. So, for example, if grandparents were paying school fees for their grandkids, there would be, some sort of documentation, some sort of letter that said that the grandparent would commit to keep paying the school fees. And it's not a legally binding document. If they fall on hard times, they're not going to get sued by their kids or their grandkids to keep up the payment. But the point is, you write that letter as evidence for HMRC as part of this IHT exemption of regular income, the fact that there is this commitment, the regularity, saying that the intention was there. So that's the gifts out of income exemption. Then the next one is the one that a lot of people know about. Pretty much most people will heard about the 7-year rule. And specifically, it's called a potentially exempt transfer, or a PET. Now, what happens is you give away assets and they will fall out of your estate for inheritance tax as long as you survive for 7 years after giving away those assets. Now, what people don't tend to realize is that if the individual, the donor, dies within 7 years, then that is known as a failed PET, failed potentially exempt transfer, because it becomes it's no longer exempt. Hence the word, it's called a potentially exempt transfer, but you die before the 7 years, and it's not an exempt transfer. and tax has to be paid. But it's the donee who has to stump up the tax on that gift that they received. Yes, there is a taper in place which applies if you die between 3 and 7 years after making the gift. So basically, you will have to pay, or rather, the donee will have to pay something, but it's the regular rate of inheritance tax is reduced the closer it is to that 7 years being reached from the death of the donor. And you can see problems with this normally arise. Say you've got some parents and they are giving assets away in the form of cash to children. So let's say you've got parents and they've got 2 kids and 2 adult kids, and they say, right, we will buy a house for one of the children. So that is a potentially exempt transfer. The fact that they've used that cash to buy an asset for their child, it's eroded their estate, so that is a potentially exempt transfer. And then a couple of years later, they do exactly the same for the second child. So that's 2 potentially exempt transfers, more or less back to back, a couple of years in between. Now, from an IHT perspective, if one of the parents was to die before 7 years, say 7 years from the first one, then potentially what happens is in terms of the annual, the lifetime allowance that you get for inheritance tax is 325 grand. So first of all, you would allocate that against the potentially exempt transfers in the previous 7 years. So the point being that it could be that the first child who got the house bought for them, there will be no IHT to pay, even though the parents died within 7 years, or one of the parents did, because this 325 grand covers the cost of the house. But once it's exhausted, then there'll be IHT payable on the second house. So you can see all sorts of implications here for families falling out, where on the face of it, they try to be equal for the 2 kids, bought them each a house, and yet the first one has no IHT to pay when the parent dies, but the second one could have a big IHT bill. And how do you deal with that? And it can create all sorts of friction. So something to bear in mind on the potentially exempt transfer. Now, the Office of Tax Simplification, OTS, which is a body that was set up about 10 years ago to try and make UK tax less complicated, for want of a better phrase, set up by the government, and they recommend all sorts of things to the government constantly. And one of the things they've been looking at recently is inheritance tax and how to make IHT easier. And the recommendations for IHT from the Office of Tax Simplifications, there's 4 of them. The first one is that they should increase the annual exemption. So that's £3,000 a year for this year and the last year that everyone gets. Because it hasn't moved since 1981, they say, look, that should be increased. So 40 years worth of inflation there. The second recommendation that the OTS say is that taper relief should be abolished. So the fact that the IHT, if you die between 3 and 7 years, it's tapered down. They say that should be gotten rid of, trying to simplify things. So that's to the detriment of taxpayers. However, an increased annual exemption, of course, would be for the benefit of taxpayers. The third recommendation, they say, is to reduce the survivorship period from 7 to 5 years for the pets, which is good. So therefore, as long as you survive within 5 years of giving the gift, no IHT, rather than 7 years. And then the fourth one, they've just recommend abolishing some of the other exemptions that are out there. So that's just an overview on where we are with lifetime gifts for IHT. I think specifically the takeaway from this is, look, that £3,000 annual exemption it's not great, but it's better than nothing, especially if you can double up and do 6 grand or 12 grand per couple. But it is per donor, not per donee. I think a lot of people think it's the other way around. And the gifts out of regular income. Not many people are doing this, but they should be doing this. Because the whole point of this is to try and give away assets so that they're not left in your estate, and doing it the right way. You know, this is what's going to reduce your estate for IHT. So the gifts out of income, it's not that difficult to get that right, keeping records and having a degree of regularity. And then, of course, on the potentially exempt transfers as well. It would be great if they did bring that down from 7 years to 5 years. But remember, it's not as straightforward as just surviving 7 years. Like I've said, a few little things to watch out for, particularly in the example with a couple buying a house for the first child and then a year or so later for the second child. And then how do they equitably split any IHT that might be applicable? So that's just an overview on some IHT planning, particularly around what we call lifetime gifts. I've done a separate video on IHT planning for the death estate. So what happens when you do have an estate when you die, which could be subject to IHT? Is there anything to get that down? Anything you can do with that? But in terms of during the lifetime for giving, then I hope you like this video, and please do subscribe here.